What's up, everyone? Thanks for tuning in. This is Donato from DXE Properties. Today, we're going to be continuing our learning series, and we're going to talk a little bit about how sponsors make money.
Josh with DXE also here. As you guys know, we are a real estate investment firm. We're deal sponsors. We syndicate every deal that we do in some way, shape, or form. And what we want to talk about here is really just paint a landscape of the different types of fees, some of the different types of structures, what you should be aware of as a investor, as a sponsor, as a aspiring sponsor, and talk through some different perspectives, really to arm you with the right questions and information. But us as a company, we are predominantly focused on multifamily acquisitions in the Southeast. We take a value-oriented approach where we're really looking for unique opportunities that have quantifiable upside where we don't have a reliance on market appreciation.
All right, so let's get into it. So how do sponsors make money? Sponsors make money in two different ways. They make money through the fees that they charge at the investment, aka the investors, and also the carried interest that they earn through the life of the project. So the first fee that you're going to see in any project is called an acquisition fee. This fee gets paid upon closing of a new acquisition, and it's really to, pay the sponsors for all the work that they've done leading up to the deal, including, all the work they do on the dead deals, underwriting the deal, putting it together, flights back and forth if they're needed, travel back and forth to properties, building relationships with brokers, etc., etc. These fees are not supposed to be a get the sponsor rich fee, and usually range between 1% and 5%. For a $10 to $20 million deal, you can expect that they'll be somewhere around 2% though. Next fee on the list is a guarantor fee. So sometimes when you go for a loan and you syndicate a deal, the bank will require guarantors, certain people to guarantee the loan in the event that you stop making payments. So there's different types of guarantees. Some of them are personal, which means that they would come after you personally. So this only affects the guarantors of the loan and not everyone investing in the real estate project. And therefore, the guarantors are taking an extra risk and therefore may get compensated in these cases. The third fee is in the event of a refinance. It's called the capital event fee. And this fee is really just it's a fee for the effort of putting together a refinance and being able to distribute funds back to the investors.
One other thing worth noting for the capital event fee, and I'm glad we didn't really speak to it, but I definitely have seen it. Some people will or some sponsors will put an exit fee in there, which would just be a fixed percent based on when the property does eventually sell. And, I think that's debatable whether or not that's a market fee or whether or not that should or shouldn't be included and what that fee is. But I think I've seen anywhere from a quarter point to a full percent.
That's a good point, Josh. So the next fee I want to talk about is the project management fee. So sometimes you see a project management fee when it's a heavy lift of a project, including, a big capital improvement of existing project, or in the case of a development project, ground up development or redevelopment, there's always some sort of project management fee. And that's really just to compensate the sponsors for the additional time that it's going to take to watch over whatever capital project is being executed. Finally, the asset management fee. This fee is really just a call it keep the lights on fee, right? It's a fee that's charged by the sponsors for the day-to-day operation of the properties. So although a lot of these properties also have property managers, An asset manager is really overlooking what the property manager is doing, making sure all the bills are paid, and driving the project forward, whether it be with the capital improvement plans or driving rents, uh, reviewing how leasing is going, and reviewing how delinquencies are going, etc., etc. So this fee is usually pretty modest and should be pretty modest, but attempts to compensate sponsors for the time that they're spending on a weekly basis throughout the life of the project.
And I would say that's typically in like the 1.5 to 3.5% range as a percentage of gross collected rents.
Yep. So the next way that a sponsor makes money is through carried interest. So Josh, you want to go through this carried interest a little bit?
Sure. So in talking about carried interest, I think it's really important, and you could jump to the next slide, to fees and the overall structure. There's different ways where the carried interest, which is basically the share of cash flow and profits that the sponsor receives. If you're going to weight the share of cash flow and profits really, really heavily to the investors, I think it's reasonable for a sponsor to advocate for more fees up front and along the way. But if you're going to have a little bit more of an equitable split between the sponsor and the investors on the carried interest side, then you would really expect more reasonable and likely lower fees up front and along the way. So I know I'm not providing that much definition in there, but I think it's worth considering as we continue through this. So a few terms to be aware of before we start talking structure. So your capital stack, that basically is all of the debt and equity and associated components that make up the acquisition. So in an acquisition, you may often have debt, like could be a bank loan. Then after that, maybe there's some mezzanine debt. Then after that, there may be preferred equity. And then after that, you may have just common equity. So when I outline it in that order, that's basically the order of payments that ultimately is owed. If the property sells, what gets paid back first? It's always going to be the debt to the bank. Then you're paying back any second loan positions. Then you're paying back any preferred equity, and then you're paying back the common equity and sharing upside from there. So as there's more and more layers involved in the capital stack, your position as just an investor becomes that much riskier. So hopefully that makes sense there. The second term to be aware of is preferred return. So right now in this market, it's very, very common to have deals structured where the investor is getting a preferred return, meaning that an investor is going to achieve X% preferred return on their investment before the sponsor begins sharing in that cash flow. So in this market, I mean, depending on the deal class and profile, I would say you're seeing a preferred return anywhere from 5 to 8% for multifamily, and maybe even higher than that for different redevelopment or developments. So I think that if you're a sponsor or if you're an investor, that's something that you should be putting out there or expecting. A catch-up. So this often ties into the preferred return term. If there is a preferred return, often there's a catch-up. And that would mean that the sponsor is able to earn their share on the preferred return and get caught up, for lack of a better way to define it, after that investor has been paid out that preferred return. A hurdle, this would be, I think of hurdle as an incentive. So we'll often do a hurdle at 12%. So once an investor's achieved 12% annualized compounded return on their investment, then the splits will change. So maybe we're earning 90-10, investors getting 90, sponsors getting 10, and then you hit 12%, then anything after that may adjust to 70-30 or 60-40. And the point of that is really to align the sponsor to be working that much harder to achieve that hurdle and those more advantageous splits. A waterfall is similar to a hurdle. It's basically a second layer to a hurdle. So maybe you have that first hurdle at 12. If there's a second at 15, then you would consider it a waterfall. And maybe those splits are changing from 90-10 to 80-20 at 12, and then 60-40 at 15. That waterfall or that hurdle, if I'm an investor, and I'm never really overly concerned about that. To me, it's alignment. And I want my sponsor to be working that much harder to really ensure upside on that project. And if they're able to achieve that, I don't mind my sponsor making the bulk of the money there. Part of that becomes personal and investment preference. But for me, that's my take. I passively invest in deals, and I prefer to see lower fees, but higher hurdles for the sponsor to make more money into. In terms of what investors need to consider, structures to be wary of, depending on accent, I think to me, and Donato, I mean, feel free to chime in here, but to me, I think in this market, if there's not a preferred return, it's probably not a deal that you should be doing. I just think it's the norm today, and to give up and not be seeing some of that, I would probably step back. I think that number 2 for me.
Yeah, just to add a little bit on that one, Josh, really, I believe in the preferred return as well. And it's because it's really showing that you're putting the investor first. The sponsor wants the investor to make money before they make any real money. And that's, what should happen.
Yeah, I totally agree. I think the other thing that I spoke to it at least in part, but just to retouch on it, are like very, very fee heavy structures. I mentioned we don't do exit fees. I think to me it's a bit egregious if you're going to be realizing your upside on the exit to add an exit fee on top of that. I don't see as very fair. To me, there should be a fairly short list of fees, and ultimately the sponsors driving to earn and working really hard to earn in the carried interest for that project. If someone's getting paid a 4% acquisition fee, I'm really, really scratching my head. And I really would not consider that fair. In terms of what's a fair structure in this market, I think that much of what we covered is going to be involved. I'll focus on the carried interest portion for what should be fair. But on the multifamily side, I think a 5 to 7% preferred return is, quote, fair. I think it's very, very common to see a waterfall after that, whether it be 90-10 or 80-20 as that first hurdle level. I think that's very reasonable. And then I think somewhere in the 75-25 to 60-40 range for that second hurdle of the waterfall is reasonable. I think that if investors...
To point out though, Josh, for example, it's all on a sliding scale. If the preferred return is down at a 5%, then I would expect a 90-10 for that first hurdle. If the preferred return is up at a 7 or 8, then I expect the split more of an 80-20 or, even a little bit more towards the sponsor, because the investor is getting back a good return at that point before the sponsor makes any money.
Yep, totally agree. And then, along different lines, which I think are probably even more important than the structure, is who is behind the deal. Really understanding who the sponsor is, having just trust in that sponsor, vetting their track record, vetting them as individuals, and just having a feel for their access and reliability at the end of the day. Not every single deal is going to go perfectly well and go perfectly according to plan. In fact, I'd say none will. But you really are choosing and selecting a sponsor that you want to be able to go through both the positive and negative with every transaction.
Yeah, I think when people are investing into a deal and a sponsor's putting together a deal, everyone's excited about the numbers and how much money they're going to make. What you have to ask yourself is, you know, do you trust this sponsor if things go wrong? Do you
Yep.
trust them to make the right decisions? And by wrong, I don't mean lose everyone's money, but, the hiccups along the way. Are they going to make the right decisions on behalf of the whole partnership?
Exactly. And then lastly, return expectations. I do think one thing that's important to consider is risk profile when you're investing. It's very, very easy, like Donato mentioned, to get enamored by different numbers. I mean, you could chase a development deal in a tertiary market, and you could be looking at projected returns that are extremely high, IRRs of over 25, whatever it may be. Um, but when you are looking at that investment, are you being cognizant of the what can go wrong? If you're investing in performing multifamily, when it comes to real estate, that's in a strong market, that's probably the most stable bet that you could be making. And if we are talking multifamily for the sake of this presentation, I think it's reasonable to expect over the life of the deal to get 15% or so cash on cash return annualized. I think at the end of the project, earning that in a tax efficient way is still very, very attractive these days. And I think it works as a nice, just diversification play to any other investments that you may be invested in. But again, I just think the important part is really, really weighing the entire risk profile with any project that you're looking at.
All right. So, Josh, I think that pretty much wraps it up. We want to thank you guys for all tuning in. Hopefully, you learned something today. Check out our other YouTube videos. And as always, feel free to reach out to us individually. We're, very accessible. We answer our emails and always happy to help.
Thank you.